Hello.
Hello.
How I sound? Good?
You good? Right. Yeah, we're good.
What's up, guys? It's Tuesday. It's 5:30. And you know what that means. It's an all-new edition of What Are Your Thoughts? My name is Downtown Josh Brown. I am here, as always, with my co-host, Michael Batnick. Michael, say hi.
What is up, ladies and gentlemen?
We have a full chat, I'm told. Let's see who's here. Cliff, Magnus, Chris, Sean is here, Jerry. Everybody got here nice and early, too, which I love. John Carlo, Random Trends, Todd Dennis. How about some names that maybe are new to the proceedings? Should I pull a couple?
Shall you? Absolutely.
All right. Greg Jones. Hello. How are you? Rachel's here. Gel Zap is here. We got Jack Rosenfield. Everybody's in the house. Georgie, we see you. Y'all say hello to Nicole. Nicole is monitoring the chat. If anyone gets out of line,
everyone
she's
behave.
Authorized. You know what's crazy about YouTube, and it's different than every other platform, and I low-key love it as a creator? There's a feature, not block and not mute, hide user from channel.
Oh,
what
so
that means, they don't even know, and they're just talking shit. But they're talking shit for 1,000 years, and nobody is seeing it. And that to me, that's like very, that's my
smart
spirit animal of features on a social media. I love that idea of just like enforced apathy. Like we don't even care. You could say whatever you want. No one's going to see it.
Nobody cares.
So, all right, guys, we have a sponsor Michael's going to tell you all about, and we have a lot to cover tonight, so buckle in. It's going to be an amazing show. Who's sponsoring the show tonight?
It's Crane Shares. We've spoken a lot over the last year about an explosion in different thematic ETFs, and one of the big categories are the buffered ETFs with downside protection. This is not quite face blower category, but like, did you know, Josh, that KWEB has outperformed the S&P over the last year pretty substantially?
Most people don't know that.
Up 43%.
Yeah.
Compared to the S&P up 23%. And with sentiment bombed out, that's kind of interesting. But I bring that up to say that zoom out, it's not that great. But for the last year, KWEB has outperformed. But there are people that want exposure to Chinese internet stocks, but they don't want all the smoke. So KWEB or Crane Shares came out with two products. One of them, K-Pro, offers 100% downside protection at the expiration period. And you're capped at a 20% gain for the next 12 months. They also have one, K-Buff, same thing with a 90% buffer and a 40% cap. So if you want exposure to Chinese internet stocks, but you maybe don't want all of the smoke, check out Crane Shares to learn more.
Chinese stocks rallied today when President Xi announced China's counter tariffs against us. He's in on the game. It's all a big game.
I've been meaning to get long these names, and I just haven't. But there's still time.
They've been working. The buffered approach is smart for people that they want exposure and they're willing to give up some of the upside because they don't want as much potential downside. And this is America. We invent things to solve problems. That's a problem people have. Is there a specific Crane Shares thing they're supposed to go to, or craneshares.com?
There's the URL in the show notes.
Tell them you know Michael Batnick. All right.
Yeah,
so this week was the Tariff reality show. We all knew it was coming. It had been widely promised throughout the course of the election. And here we are. And it got off to a pretty exciting start on Friday. Trump shared via Twitter, as most presidents historically have, that there would be 25% across the board tariffs on Canada and Mexico until they got serious about helping us combat the flow of fentanyl into the country and illegal immigrants. And there was like a little extra something on Canadian energy. And then there was a China tariff because, when you go see Trump, you want to hear the hits. You know what I mean? If he just did Canada, Mexico, people are like, all right, but you're going to do China, right? He closed with China. Also tariffs on China. And then she is like, oh, okay, cool. Here's my tariffs. And then, or maybe just prior to that, there were negotiations already. So it's like, actually, I'm talking to the Prime Minister of Canada. I'm talking to the President of Mexico. We're going to figure this out. And there's a 30-day pause. Dude. So it was like the stock market laughed like it should have.
We need to bring avocado manufacturing back to the United States.
I have said this for a long time. I want to like give you a little bit of a rant on my take on the tariffs, and this is not to dismiss any of the analysts or strategists or economists who have spent the last 3 days writing about this. I understand like it's almost obligatory. I have to tell you, I have personally spent zero time writing, speaking, or thinking about tariffs. Like literally zero. The degree to which I don't give a fuck must be measured by heretofore uninvented quantum computer-driven innovation. Like the technology, the instrumentation has not been devised to measure the degree of my complete and utter apathy for the entire topic. Maybe if I were importing strawberries, I would feel differently. But as an investor, I'm so out on this. 30 days will go by. We'll do it again. I won't even notice. And one of the reasons why is because I understand where all of this is coming from. It's here. Let's put this image up. This is Donald Trump in 1987. Let me tell you a quick story. Donald Trump bid on a piano that was featured in the movie Casablanca, and he lost. And the winning bid came from a Japanese trading company buying it on behalf of a Japanese person. And that really pissed Donald Trump off. So he went on TV with Diane Sawyer, and he screamed about Japan, the same way he does today, chart off about China. This is a quote. I believe very strongly in tariffs. Guys, listen to me. This is 36 years ago. I believe very strongly in tariffs, said the Manhattan real estate developer. He starts criticizing Japan, West Germany. That was a thing back then, literally West Germany. Saudi Arabia, South Korea for their trade practices. Quote, America is being ripped off. We're a debtor nation, and we have to tax, we have to tariff, we have to protect this country. It's not about anything. It's the way that he holds the news cycle in the palm of his hand. It's the way that he likes to open up negotiations. We all learned this. It's like, all right, we get it. Throw a punch, have the meeting, then come out with your arm around the person. Look, we get along. I saved us from the tariffs. Like, how fucking stupid do you honestly have to be to publish a piece with the percentage probability of a U.S. recession? Like I saw from some of the banks. Are you serious? So that's kind of like the root of my apathy. This is something this man has been talking about for 40 years. There's no rhyme or reason to it. It's just he's fixated on it. He loves it. It's never going away. We'll be talking about tariffs next year. We still have to invest, guys. So what? Am it too much? What are your thoughts? Am I losing it a little bit about this, or am I exactly right?
Well, I unfortunately was glued to my phone on Sunday night, like waiting for the futures open, because I was of the opinion, I did believe that come Monday, this was going to be rolled back and it was going to just all be a tactic, but I didn't know for sure. And so as far as the banks are concerned, this is their job. You know that. They can't not publish stuff. But the more important thing, from the point of view, forget about the news and the noise and the rhetoric, from the point of view of the investor, okay? Because there are real world implications here. Like, this could really fuck people's lives up, like big time. So I'm not talking about that for a second. Just from the point of view of the investor who's watching and listening to us right now. Yesterday, you were talking with Nick and Jessica, and Nick Colas made a really good point. For all of the noise that we're going to be dealing with during the presidency, and there's going to be a lot of it, we also experienced this in his first administration. And guess what?
This was my point.
80, I think this is a stat, correct me if I'm wrong, 80 of the 100 lowest closes ever for the volatility index, for the VIX, happened during his administration. And I think the market has gotten wise to his rhetoric and is looking past all of the noise, because at the end of the day, this is, for better or worse, probably, well, whatever. This is a negotiating tactic.
Sorry, there are no presidents that start off their first week in office doing something to deliberately cause a global recession. In no way would any president think that that's like the way to get started. So he could talk about tariffs. He can use them to ensure cooperation at the border. I don't hate it. Like, he got people's attention. It's somewhat effective. I'm not for fentanyl. I'm not for illegal immigration. Like, I'm not pro those things.
The actual idea of tariffs, though. Again, the negotiating thing, yeah, fine. We got some stuff done, but the actual idea of tariffs and what they do for global economy, it's a negative sum game. It is economically destructive. You are levying a tax on the companies importing these goods that is passed directly to the consumer. Like, it disincentivizes trade. It's horrible.
There's this cottage industry of people now who are like bending their brains into pretzels to try to write tariff-supportive economic commentary. Like, no, actually Trump is right. And some of the shit I've come across is like, but it's so much worse without tariffs if we let, like look how bad NAFTA was for the middle class. And it's not to say that any country should just do whatever they want and we should be the only country that plays by the rules. And without a doubt, there are countries that have taken advantage of free trade with the rest of the world and have not played by the rules. So no one is saying that Trump's 100% wrong. I think the bigger picture is like the last time the tariff stuff was about China, which is probably where the focus should have been. Now, Americans get a benefit from trading with China and having a trade deficit in the form of all the shit they buy at Walmart. But that's a whole other topic. I think what's jarring this time is he went right after two countries that are, like, geopolitically our best allies.
And biggest trade partners.
And so that's where it's different. Canada is $400-something billion a year in trade, and Mexico's closer to $500 billion, and that's different than having this like global showdown with China. I want to end this topic though with what Nick talked about yesterday, because I thought this is a really great framework. We have this data trek playbook for negative market catalysts, and
so Josh,
the questions to ask, and if you missed the video with Nick, it's available on YouTube. Does it materially increase the risk of recession? Does it materially threaten financial stability? How do policymakers respond to the catalyst? So remember, for every action there's a reaction. And lastly, how does the U.S. stock market respond? So Nick points out, we really didn't get a crazy VIX spike.
It was at 20. It was nothing.
Yeah. Policymakers, well, we are the policymakers in this case. I guess the Fed would be the relevant policymaker. What do they do in response? Does it materially threaten financial stability? I doubt it. And does it increase the risk of recession? I could go either way on this. I'm not a trained economist. I feel like a very large part of our economy maybe would suffer as a result of tariffs, but I don't think it's quite the same as a trade war taking place in the 1970s. So I looked right through it already. I'll keep looking through it, and that's kind of my framework for how to survive the tariff reality show. You want to take over here?
Yeah, let's keep it moving. I mean, yes, I agree. At a bare minimum, it's going to cause noise, but there's no investing philosophy that can be implemented based on the swing. So let's leave it at that. Okay, let's talk about earnings. You know, there's been the news cycle has been so noisy that between DeepSeek and between the proposed tariff, the threat of tariffs, we stopped talking about earnings and earnings season, which ultimately is what's going to drive markets in the long term, have been off to a good start. So ChartKid shows that the path of earnings growth, the estimated earnings growth, has been revised higher for sales as well. So good news there. As far as earnings season so far, we've got about 50% of the market cap has reported, a little bit more after today. Profits are up 10% year over year, 250 basis points above estimates at the beginning of the season. So off to a good start.
Can we put the first chart back up? Strong Q4 earning. I mean, look at this. Look at this revision. It's like, I mean, dude, not everyone is beating, but pretty much everyone is beating. And let's run through some of these stats. Chart off. 50% of the S&P 500's market cap has reported, and that's as of this morning. So I think if you add an alphabet after the close, it's more. 10% year-over-year earnings growth for the quarter is outstanding. That's number one. Number two, S&P 500 profits up 10% year-over-year, but being 250 basis points above estimates from where we started just this season, I think is pretty bullish. And then almost 80% of S&P 500 companies beating earnings, 79%, and the 5-year average is 77. So we are ahead of where most people would have supposed we would be on a lot of metrics. And now even revenue is growing. One of the problems at the start of this rally is that earnings were growing, but revenue had been slowing down. And people were like, oh, these companies are going to run out of levers to pull. Well, now we've got revenue growth continuing into yet another quarter. 8 out of 11 sectors year-over-year increase in profits, also pretty outstanding. And the energy thing, like, you could almost disregard it because there's so much commodity noise in those companies' quarterly numbers that's so far outside of their control. It's almost like it's almost not even worth paying attention to the percentage of energy companies beating, because they can't forecast natural gas and oil prices no matter what they do. So I thought outside of that, seeing pretty much every sector flat to up is pretty important. Can we talk Palantir for a sec?
Sure.
This is among the stocks that I most hate myself for not having paid close enough attention to since it came public. Why do you think it is that we just never really, or a lot of people just never really paid any attention to this thing until last year?
Because we never touch it in terms of our actual lives. It's not Apple. It's not a consumer name.
Oh, that's a good point.
It's not a search engine. It's not a social media thing. Like, it's so far outside our daily lives. And now I know it's been a hugely popular retail stock, and credit to all of the retail. It sounds derogatory. Credit to everybody that's been on the ride, because it's been a hell of a ride. And this is the type of name that professional investors hate. So
why do they
investors win again?
So this is one of those names. Like, let's put up the chart.
The charts tell the story of why air quote professionals hate it.
Okay. So where you see a gray dot is earnings. And you can see, like every other technology stock that came public during the pandemic, which Palantir did, I think they did a direct listing, so nobody on Wall Street. Let's do chart off for 1 second. Strike one. You do a direct listing. What that means is you launch a ticker symbol and shares become traded on the exchange, but you didn't sell any stock in that transaction to the public like a traditional IPO. You listed existing shares that your employees and your investors owned in the private market. Strike one, because nobody got paid, or the investment banking fees are tiny compared to what would happen if you were to sell $1 billion worth of stock. So right off the bat, the analysts don't like you because their investment banks they work at have no interest in you. You have not paid your dues, so to speak, on Wall Street. So they're not tripping all over themselves to cover the stock, upgrade the stock, take you around to institutions, all the bullshit. They don't do all the, they don't give you the VIP treatments. That's number one. It's very shareholder friendly though. It's very employee friendly as well. And it's a good sign that nobody wants to sell a big chunk of stock and that you're already well capitalized. They're not the only ones that have done that type of deal in this era. I think Spotify did that too. Strike two is you came public in 2020. So you look like a fucking SPAC. So people that don't know the story, idiots like me, they're just like, look at the chart. Oh, I see. It went from $5 to $40, and then it collapsed to $20. I don't buy shit like that. So that's my attitude before I know anything about it. So that's strike two, the timing of the IPO. People are just in 2022, by the time you've been around for 2 years as a public company, people have no interest. So that you could see this thing flatlining in the teens. And then strike four, to your point, Michael, they don't make a phone. They don't have a consumer social media thing. We don't watch video on their platform. They are doing hardcore AI work for Fortune 500 companies and the government, the military. Yeah. Mm-hmm. Yeah. So
There's
like for all of those reasons, if you're just like a dilettante and you're not like really focused on identifying companies like this, you missed it. One thing they had in their favor is Alex Karp is just an incredible persona. He's doing his conference call today. It looked like a podcast.
Well, he's very outspoken. I don't think
Yeah.
I'm using air quotes professionals like that. But the real one, Josh, is the valuation. So let's run through this. So Palantir's growth now, and listen, they've had explosive growth, like earnings wise, but it's a lot of the growth in terms of the stock price has been driven by multiple expansion. So of the 504% gain over the last year, four-fifths has more than that has come from multiple expansion. Chart 2. Look at the forward PE and the forward price to sales. And maybe in a vacuum, you're like, yeah, it looks high. But check this out compared to Tesla back in the day. So ChartKid overlaid Tesla's forward PE in 2014 and 2015 when it was like the craziest valuation. And of course, we know how that ended. It very much grew into its valuation. And then some. Palantir looks similar. So people just don't like, or people that got their MBA and spent time on Wall Street doing intrinsic value and discounted cash flows, they can't wrap their arms around story stocks. And it's just not for them. And of course, there's like resentment and stuff, that they missed it. So anyway, it's been a hell of a ride, and congrats to everybody that owned it.
He's also the bête noir of like a whole coterie of professional short sellers. I kind of think he's the new Elon Musk. Like they're not shorting Tesla anymore, or at least I hope they're not. This guy had a stock price that went from 13 to 30, and I think he attracted a lot of negative attention from shorts. I think Chanos, when he was still running the fund, was betting against this thing. I think part of it is he talks very hyperbolically in his public pronouncements, Alex Karp, and he's like very animated, and it's a little Elon-esque. He's got the big James Altucher hair.
Yeah.
Like there's a lot of elements to this that you picture a cynical professional short seller, just like who is this jerk off?
Yeah, he's a showman.
He's a showman, and you're right. They really don't like that, and that makes them want to dig in and do work on something.
It's the same thing. It's the same thing as Tesla. So the percent of shares outstanding that are sold short got as high as just under 8%, and now it's down to 3%. So it's still relatively high compared to the average stock, but nothing like Tesla back in the day.
Somebody in the chat is suggesting that Elon might get jealous of all the attention Alex Karp is now getting. And Elon effectively is the king of America. That'd be an interesting subplot if these guys were playing on the same side and they're all on this America First kind of bandwagon. And then there's not enough room for two of these guys to exist.
Well,
I don't know.
Not knowing anything really about the story, but if there's access to an infinite runway of government spending with AOI, it makes sense. I'm not saying that it's, I'm not commenting on the future path of the stock, but it makes sense why it would trade at these seemingly ridiculous valuations.
I like this guy, and I saw him. Bill Larson is saying I saw him on Bill Maher and bought the stock the next day. I also saw that appearance, and I should have bought it the next day, but I didn't. But he's got this shtick where he's a progressive. He's not like one of these like I'm like the new right wing guy. That's not his thing. But he's extremely pro-Israel and extremely pro-America, and I think he became really outspoken.
Very anti-woke.
Very anti-woke because I think he thinks it threatens the country's ability to defend itself, and he is like very heavily focused on defense.
Yeah.
So it's a really interesting, like you can't like put him in a box and be like, oh yeah, I know who this guy is. He's not a stereotypical anything. And he has a book coming out later in February, which I almost feel like the audio book is the move with this guy, but I'll check that out. Anyway, I missed this and I apologize. Chat, I'm sorry. I've had this on my list of best stocks in the market pretty much all year last year. I just never got around to talking about it.
I don't buy names I don't buy stocks like this. No disrespect. It's not.
I don't know if I would or I wouldn't have, but I just.
Well, you didn't. You didn't. So
I didn't.
There you go.
Escaped me.
Let's talk about Alphabet, Amazon, and Uber. I own all three of these stocks. So do you, right?
I mean, the whole world does technically.
Yeah, true.
Alphabet is out, and it looks like it's selling off in the after hours. All right.
Yes, it is. It was down 9% last time I checked.
Okay. Google search up 13% to 54 billion. YouTube ads up 14%. Google network looks like minus 4%. Google services total plus 10% to 84 billion. All right. The cloud business grew 30% to 12 billion, which I think was the number.
Yeah,
that was the number that they had to do.
Yeah.
Okay.
No, they missed. That was a miss. There's two reasons why the stock is selling off. First of all, so it did. What did YouTube do? 10.5 billion. That's more than Netflix did last quarter. Let's just pause for a second. That's more than Netflix did. Wild.
Interesting.
So these are the numbers. John, next chart, please. I had ChartKit pull up Q4 2019. So total revenues doubled. Again, this is from 2019. 46 billion then. What is it today? 96. YouTube was 4.7 billion. It's $10.5 billion today. So basically every category across the board has doubled in the last 5 years, which is insane chart off, considering that in 2019, Google was not a small company, right? Google was very much, remember like the law of large numbers, these trees don't go to the sky. This fucking tree is growing to the sky. It's wild.
Some do.
So
some do.
What really sent the stock is they see 2025 CapEx at 75 billion, LOL at DeepSeek, being like, whatever, we're not spending money there. So check this out. Let me give a plug for Quarter, a company that we're an investor in. I asked Quarter, why is the stock down 7% in the after hours? And it gave 5 reasons. And the one that caught my eye was this $75 billion investment. The way they say it might also raise concerns about increased spending and its impact on short-term profitability. And interestingly enough, Consensus Gurus, who tweets all of the results and everything like that, said that Broadcom jumped 4% on Google's CapEx guide. So it's funny, Josh, you and I were talking to Dan Ives recently, like how much runway is the street going to give these companies on CapEx and turning that into revenue? It's early, it's one day, who knows where the stock will trade tomorrow, but so far the street does not seem to like this.
So they think the $75 billion guide for CapEx this year, which is ahead of expectations. Right.
Big time.
Yeah, because the expectations
was 57.
Okay, so they think that spooked the market and investors sold on that news.
Yeah.
Okay.
I
love that. I love that Quarter has this AI
sick.
thing built into it. It's so sick. It's like having an analyst like sitting right in front of you. It's crazy. There are guys that do this for a living. They sit on the desk, and any trader can ask them, "Hey, why is the stock moving?"
Right.
And it's their job to figure that out. Now, I don't need to pay the kid in the vest. You know what I mean? Who needs healthcare and vacations? Now I just ask Quarter. It's pretty dope.
When's Amazon? Tomorrow?
So Amazon is Thursday at the
okay.
close, not tomorrow. Tomorrow, we'll talk about Uber in a second. Tomorrow's Uber, and Uber reports in the morning because they do it from New York, not from California. And Dara likes to be on set with Andrew Ross Sorkin for Squawk Box. He does he basically does a sit down with the notorious ARS every earnings report, which is pretty cool. But Amazon. All right, so let's do the Amazon chart. Here's last 5 years price. The stock has been annualizing at 19% a year for the past 5 years, but that's very misleading because look how vicious this drawdown was from late 21 into 23.
Well, yeah, Josh. Guess what?
About all of it.
Guess what, my friend? Amazon divided by the S&P is well below the peak in July 2020. So from July, Amazon is pretty significantly underperforming the overall market, which is borderline face blower stuff.
Poppy, I was on this show last fall saying this is a $250 stock masquerading as a $170 stock. I said it like, I don't know, 10 times. Now it's 250 and I want 300. I don't know if I'm getting it near term, but like, all right, let's look at some of the expectations, then we can move on. $1.48 would be 48.5% growth year over year. Revenue is a 10.2% number, 187 billion. Guys, a quarterly revenue, okay? Just so we're all on the same page here, how big this company is. Analysts are looking for 19.3% growth in AWS
That's
revenue.
usually the number that moves it.
That's the big number. Last 4 quarters, year over year operating income growth. You ready for this?
I'm ready.
Plus 267%, plus 221%, plus 91%, plus 56%. So coming out of the post-pandemic tech crunch, they got their expenses in order. They fired a lot of the people they needed to fire from the pandemic era splurge, and they have been more efficient with last mile deliveries, which they now wholly own. They're delivering more packages than UPS now. They choked back the leash a little bit on expectations from like oh, we're going to deliver things in an hour, not that 24 hours. And of course, that was good for reining in costs. So this is where we are with Amazon. I think part of the story here has got to be Anthropic and justifying the spending that they're doing on AI. But one of the good things about DeepSeek and cheap AI is that Amazon's primary AI interface is called Bedrock, and it's a bring your own LLM sort of situation. DeepSeek is available on Bedrock AI. Amazon made it very clear, like, we allow usage of the cheapest, most efficient LLM all the way up to the most expensive. It's all available on our platform. And that now looks like a very smart decision, to have a buffet rather than here's our LLM, you're forced to use it. So we'll see what happens, but I'm going in long. Let's do Uber. The stock is like flat year over year. It was ripping all through 2024 until Elon started with the cybercab shit, and then that was it. And the stocks had multiple sell-offs related to the threat from Tesla, and that's really the only thing investors care about on the conference call. So right now you got a stock that is valued at 17 times forward earnings, growing cash flow by 50% year over year. Revenue growth is on fire, but people are nervous that Waymo and Cyber Taxi are going to steal their thunder, and there's not going to be enough autonomous cabs to go around. I don't fully understand why people think that, but I'm on the other side of the market from this one, Michael. I think
you and me both. Listen to this. So Gene Munster tweeted. Gene Munster's an analyst, tech analyst. He said on Waymo, Sundar says it has served 4 million passengers, now averaging more than 150,000 trips per week. Wild stuff. It better be more than 150K per week because the 150K data was given 3 months ago on September earnings call. My guess is the weekly is closer to 175. But yeah, there's competition. This is all the market cares about right now.
Yeah, I think the one of the negative things that happened last year was that GM gave up on Cruise. So Cruise was the autonomous vehicle division of GM, and they were going to have a taxi service, and they had been piloting it in San Francisco, and this is more than 10 years. And unceremoniously, they were like, actually, you know what? Forget it. We're not going to do it at all. They just fired everybody, and people sold off Uber because it's like, well, do they have a dance partner? Like, what are they literally going to do? Now, the Eats business, which is half the company, is not susceptible to autonomous driving. They're going to try to use robots, but like, I don't think they have really a threat there. And a lot of drivers do both. So I don't think this is black and white as the people who are selling it on Tesla headlines think it is, and maybe the market's right and I'm wrong, but I think I'm right, and I'm sticking to my guns here. So
Okay.
we'll find out. We'll find out tomorrow how the quarter went, at least.
Okay. All right. I'm going to talk briefly about this. We don't spend a lot of time on this, and this will be the last time I'm going to bring this topic up until there is actually regulation. This will be the last time I speculate on this topic. But Jonathan Gray, the chief operating officer at Blackstone, was talking about private assets in your 401k. Came up on the call. So here's what he said. Where we start is the way the defined contribution and retirement business has evolved, and I do think it's created a bit of a sort of haves, have-not environment. So if you think about it, wealthy individuals are able to access our products through financial advisors and get the benefit of strong long-term returns and compounding. If you were an employee at a major corporate sort of pre-2005, you probably have the benefit of pension fund, where people are working hard every day to deliver these returns, allocating to alternatives. If you work at a state pension fund today, you are also getting that same benefit. But for the vast majority of private sector workers in the United States, they're given a 401k plan where, because of the litigation environment, they basically focus on the lowest fees, and it's not about long-term performance. Actually, this is me speaking. In the case of funds, it really is. Lowest fees do have the long-term performance. But I think one of the things that I think this is inevitable. Like it's going to happen. One of the things that is probably most concerning to me about this aspect is, how do they decide what gets in? How does the average investor, I think most people at this point know either, okay, target date fund, and maybe that's where these go. But again, who decides what goes in there? Most people are familiar with an S&P index. How in the world are we going to allow who gets onto these platforms? So I do think that the illiquid stuff, it does make sense in a retirement plan, but there's going to be a few bumps in the road.
Do you know the thing that I'm most bullish about as it pertains to all of these products getting into traditional retirement vehicles?
The stocks of the underlying companies?
Well, that definitely. Those stocks look fantastic and they're working. But I think the most bullish aspect of it for you and I is how much disappointment there's going to be 10 years down the road, and just us unwinding all this shit for people that come to us. Like, wait a minute, I don't understand. The stock market compounded at 8%, 9%. What do I own? And then we're going to be like, well, you own this weird fucking infrastructure thing, and you have this piece of shit that's got like excessive fees in 5 different layers, and you have this thing that's like, you own like foreign banks that are privately held. Like, we're going to have to explain to people why they underperformed, because the person before us is just going to load them up with whoever bought them lunch. And I hate to sound that cynical, because some of these things are going to be good. It's just so hard to know in advance. Very similar to actively managed funds, very similar to hedge funds. It's really, really hard to look at a menu of products and say, this is the right one. So my take would be, if you're a financial advisor in this space, be judicious, know who you're bringing this to. If you're going to include it in a 401k, double down on educating the population of workers who are going to have access to it, and don't oversell it, because this is not going to be any easier than vetting actively managed funds, which we already have enough evidence for a lifetime to know that people can't do that anyway. So it's not going to be easy. And then the last question is, ask yourself, is the best strategy in private credit going to be available in a 40-act fund wrapper? Or is that still going to go to the richest, most powerful, most connected people, the same as it always has? So do you want to buy the 8th best version of something and pay huge fees for the purpose of pretending like you're a rich person? So like it sounds great until you like think through, how is this really going to work? And I honestly think the biggest opportunity for most RIAs is going to be to fix messed up portfolios 10 years after the gold rush has come and gone. I don't know. What are your thoughts?
I'm a little bit less cynical about the whole thing, but you're 100% right.
That was pitch black.
Yeah, it's going to be a little bit less disastrous than that. Because a lot of the 401k industry, a lot of the 401k plans that we see today are pretty gnarly. But But yeah, people got to be careful, and education is going to be key. All right, let's talk about.
I think if people have the right expectations, it's better than if people are being pounded. Like you got to put 20% of your money in privates.
I guess
Why?
I don't know. I'm coming at it from the angle of all else equal. If you are going to own these illiquid assets, probably better to do it in your retirement account than in something else. That's all I'm saying.
Yeah, I agree with that. I think the good news is that the pricing will come down.
Absolutely.
One of the things that financial advisors on social media hate most about these types of private and alt investments is the fee structure and the cost. And I think now that you have BlackRock competing with Blackstone, one thing I can guarantee is that the pricing is going to be better for the end investor. I don't know how much better, but it's definitely going to be trending in that direction. So maybe that's the silver lining of the gold rush. Okay, what do you got? Is this me? Oh, this is me.
This is you.
Sovereign wealth fund for the United States. Doesn't that just sound like third worldy?
Nope, we don't do that here.
Slush fund. To me, it sounds like a vehicle through which to bribe the government.
Oh, you think? Yeah, shit.
Or for the government to pay bribes. So historically, sovereign wealth funds were for countries like Norway and United Arab Emirates, whose primary economic production is coming from like one commodity.
We have such a surplus that we need to do something with all of this money. Does that sound like us?
No. And not just money. We need to diversify the economy. So we need to take oil profits, redistribute them amongst the population in the case of Norway, and invest the surplus in anything but oil. So when you look at Norway has one of the most respected institutional pools of capital in the world. They're a huge investor. They're buying Amazon and Apple. They're buying anything but energy because they're diversifying their future. You see this in the Middle East. Sovereign wealth funds are being used to develop cities, to develop real estate, to create job opportunities away from petro. And this makes perfect sense. And this is how they should be used. I don't think we have those same issues here. This seems like Howard Lutnick from Cantor Fitzgerald, who is the economic advisor to Trump, was like, hey, let's do like a fund.
Oh my goodness!
There's a rumor that Bill Ackman might be named the head of the sovereign wealth hedge fund.
Fuck that, Carl Icahn. I want Carl running the fund. So this is from Axios. What they're saying. Okay, so the potential for cronyism with the sovereign wealth fund is dizzying, and the record of current government efforts to direct investment should not give anyone confidence. You know shit. That it would be competently or fairly managed, wrote Dominic Pino in National Review yesterday. Here's another one. The United States has a ton of wealth, he adds. The federal government is a poor steward of the chunk of it that it already controls. It should control less, not more. Don't these people want government out of?
I thought these were Republicans. Why do we need more centralized investment by the federal government?
No. This is now. What's the upside?
Now,
what is the upside?
Well, the upside is the Trump family wants to control TikTok. So let me skip ahead to where everyone else will eventually arrive. The upside is Trump's got Larry Ellison on line 1, and he's got Elon on line 2, and he's got Kevin O'Leary scratching at the door like a dog, and they all want to buy TikTok. And he's probably thinking, what if I buy it? Well, how do we do that? I don't know. Can we just buy it? And Lutnick's like the country. He's like, the country, a little bit of both. Let's do a sovereign wealth fund. I want to give people a little bit of a background though on what these things really are. The first sovereign wealth fund was in Kuwait in 1953, and again, they have excess oil revenue and nowhere to put the money. So establish a fund that will make smart investments rather than under the mattress. In the 70s and 80s, Abu Dhabi came along. Singapore, famously, in 1981. There are now 176 sovereign wealth funds all over the world, managing $11 trillion. They have gone up 11-fold from barely 1 trillion as recently as 2 decades ago. So this is like a hot thing right now. China has a big one, the second largest one, the CIC, China Investment Corporation's 1.3 trillion as of last year. They have another one that's 1.2 trillion called the SAFE IC. Abu Dhabi's is 828 billion. So these things are popular in I don't want to use the term third world, it's derogatory. In the developing world, these are very popular. And in the case of commodity wealth, they make a ton of sense. I'm not 100% sure what the goal is here other than self-aggrandizement or maybe just like this is a moment in time where every stupid idea somebody brings up, it's like, yeah, let's go do that. And it seems like there's a lot of that in the air right now too. So
what if we do like a little 2 and 20, lower everybody's income tax? You know what I mean?
Give me the money back. Let me invest it. I'm pretty capable of investing it myself. I don't need the White House investing it. I don't really see. How do you even? What do you do with the profits of it? Is that a tax distribution? Like at the end of the year, what are we doing with the money? I guess maybe I can get talked into it.
Buying the dip in Google.
Yeah, we should. we should speculate in stocks. All right, I'm gonna make the case, and then you have a mystery chart, and then we're gonna get out of here. I'm pitching Bristol Myers, which I just bought myself. I bought it right around here, so it's relatively early. Nick Hollis and Jessica Rabe pointed out last night that XLV is acting really well this year, the healthcare sector in general. Sean turned up the fact that it is the second best sector year to date, 6.55%, right behind communications, up 6.59%
Does
year
look
to
good.
date.
Does look
Yeah,
good.
it really does. And it sat out the rally of 23 and 24 for the most part. What else I want to tell you? Oh, so the XLV is outperforming every other sector, and it's outperforming the S&P. And Bristol Myers has, I think, an interesting setup. This chart doesn't make it look as good as if I showed you a one-year chart, but this thing is going to break out to a new 52-week high, I believe, if there's a good number tomorrow. I don't know that will be the case, of course, but let's talk a little bit about it. They report Thursday, actually, pre-market. For the last 4 reported quarters, it beat on the top and bottom lines in all but one quarter. And people are starting to focus now on the growth portfolio here and not as much on all the patent cliffs they have and the legacy drug portfolio. And this company basically went head over heels into oncology and immunotherapy. And those are both growth markets for as far as the eye can see. And Bristol has some pretty good drugs. So it's 3% below its 52-week high. RSI is 57. It's above its 50-day by about 2%, above the 200-day by about 18%. Not at all extended. This is the chart I was looking for.
Yeah, it looks
and you
excellent.
can see, so that level is like 60 to 62. Yeah. If she clears this range on an upside earnings report, and it's not even overbought yet, like I feel like there's a lot of room here. So it's up 21% over the past year, one of the better performing names in the group. And do we have a 10-year? Oh, we did the 10-year already? Okay.
Well, she reports on Thursday, Josh.
She does.
Yeah.
She reports before the open. And
wait, are you in or no?
I'm in. I bought it.
Okay.
I'm in.
Okay.
I'm in.
Yeah.
So.
No, I know nothing about the business, but
what do I have to do to get you into the stock?
I have no more money to deploy right at the moment, so there's nothing you could say.
All right. Well, I'm long. We'll see what happens.
Yeah.
Not advice.
Speed.
Not advice, everyone.
Not advice.
All right.
All right, Josh. I'm going to make this really easy on you, okay?
Do your worst.
Okay.
You're showing me a stock or an ETF?
This is a stock.
Okay.
I'm going to make this really easy on you. It reported today. I'm very mad at myself. You said you're mad for missing Palantir, even though you shouldn't be because you wouldn't have bought it anyway. Not only should I have bought the stock, I did buy the stock. I fucking sold it. I sold it. Wait, I'm an idiot. I was bullish on God, I suck.
What
You dumb
is
idiot.
this?
You dumb idiot.
What is this?
So, all right,
Wait,
all
hold
right,
on, hold on. It's up 290% over 3 years.
Yeah.
That's the time frame.
Yeah.
Is this
Michael,
Zillow?
you dumb idiot. No, it's not Zillow.
All right. Is this? I'm going to cheat. The chat is saying Reddit, but I'm in that. I know you're not in that. Spotify.
It's Spotify.
Yeah, man.
Dude, I'm so annoyed. Like,
They just had their first, I think, profitable full year based
John,
on the report today.
we've
Is that
got
right?
a chart. We've got
Okay.
a chart. Look at this. Look at this beast. John, do we have that? There we go. Look at this. Look at this. Just an explosive upside surprise in gross margins. Their premium business exploded. They have no competition. They are the one of one, and I'm really, for the fourth time, annoyed at myself for selling this.
So I would like to share with the listeners and the viewers the way that we use Spotify. Duncan, can you pop in here? Let's see if we can get Duncan on screen. There he is. I don't think most people are even aware of this. Spotify owns a product called Megaphone.
He's washing it down. Keep going.
He'll be ready. A cheeseburger?
He'll be ready by the time you're done talking.
What is that? God only knows.
Pretzels.
Okay. Spotify owns a business called Megaphone, which is now the premier way that podcasters put their shows out into the world. How does Megaphone, what do we do with Megaphone to put our shows out?
Megaphone's where we host. It's where we host our audio podcasts. And so it's disseminated out to all the platforms.
But it sends it to Apple
Spotify
and it sends it.
Apple.
Okay.
Yep.
And Apple doesn't have a tool like that, or they do?
No, everyone pretty much uses a third party. In the past, we used Libsyn or Acast. There's a lot of different competitors there. But yeah.
Okay. And now Spotify has probably the best ad technology too, though, for podcasters, which is the most important thing.
Yeah, and they're launching it for their videos now, just as of today or yesterday.
Okay. And we are now including video with the audio pod on Spotify. So at 9 a.m. when you check out our audio podcast and you use Spotify, you can watch us on Spotify now on the same app, which is pretty cool. And there's another thing that Apple doesn't.
Yeah, Apple's behind
did I
on
freeze?
the video for sure.
That's another thing that Apple doesn't have. Yeah,
Exactly.
All right, you are this, Michael. Anything else for Duncan or?
No, Duncan, you're the best. I want to thank the audience
Yes.
for sticking with us as Josh is having some buffering issues over in the town next door. But we made it. We survived. Not so bad.
We made it.
You're getting
Guys,
shadow banned by Verizon.
Tomorrow is Wednesday. That's okay. Tomorrow is Wednesday, which means another all-new edition of Animal Spirits with Michael and Ben. We will have an Ask the Compound this week. And at the end of the week, we'll have a Compound and Friends with a special new guest to the show that we've never had before. You guys will, I think, really enjoy that. And a special treat for those of you who have subscribed to the Ownership channel. We are dropping something dope on the Ownership channel by Ritholtz, which is on YouTube exclusive. And I think that's going to go up first thing tomorrow morning. You're not going to want to miss that. So keep it locked. We love you. We'll talk to you soon.